I'm on a mission, okay? If you couldn't tell, and I think you could. This whole semester I've been on a mission to make sure that you guys know from start to finish partnership taxation, from birth to operations to its demise. And since tonight is our last class before the exam, I don't have the luxury of going into much depth about the material we've covered because there's some important things that we've got to cover tonight. So let me just say, the exam itself is cumulative, largely material we learned in the second half, but as you can see, many of the concepts that we cover tonight, you need a foundation from earlier material. So even the later stuff, by extension, incorporates some of the material that we learned early on in this semester. So just by way of a very quick summary before we get into the new material, you guys know how to form a partnership. And again, with the new tax legislation, I may never see anyone in this room again because people are hot and heavy about pass-through entities. And that is going to become the new norm, it looks to me. I am going to say my prediction, 85% chance that we're going to see this tax legislation pass. All right, you heard it here. You also heard it here. I said this in my Monday night class before the latest missile test. Times Man of the Year. You heard it. I still say Kim Jong-un is going to get it. I'm sorry I'm on tape. People are going to think that was whom I voted for, but I certainly think he made the most news this year. Notwithstanding they may have asked Donald Trump and he turned them down. All right. We have, Michelle, you have your own vote?
No, quick question. Do you think that's going to pass this year or next year?
If it doesn't pass this year, it ain't passing. Okay? Andrew?
Are you doing the final 2 times?
We are. I'm going to do that when I get more people in the room. We'll talk about that. All right. So we can form a partnership. Generally, we know tax-free. We have certain code sections at work: 721, 722, 723, 724. You guys can operate the partnership. You know what year it generally has to be. We can deal with allocations of the partnership income and deductions as long as you have substantial economic effect. You have a qualified income offset. In certain cases, when there's non-recourse liability, you have to add to the equation minimum gain chargeback. All that's well and good, but then we saw in certain instances that with respect to family partnerships, for example, 704E, and with respect to contributed property, 704C, that with respect to dispositions of that contributed property, for example, or depreciation of that contributed property, was not the wild, wild west. You had to meet the requisites of the code. We then spoke about operating distributions. And that's going to be good because what we spoke about operating distributions will play out today when we talk about liquidating distributions. But operating distributions, we know, generally, with some exceptions, not taxable to the partner or the partnership, right? Remember, whether or not there's a distribution, partners get taxed, right? Or if there's losses, they pass through. And there's a basis adjustment, right, under Code Section 705. When distributions are subsequently made, that's generally, not always, not a taxable event, right? Not a taxable event. All right. So we have distributed. We have 731 talking about not being taxable. 732 deals with the issue of what is the basis of the property being distributed out. 733 talks about the partner's basis. 734 talks about the partnership's inside basis, but generally nothing happens unless, of course, there's a so-called 754 election, right? And if there's a 754 election, there might be an adjustment under 735B. So we did speak, by the way, there was a lot of dancing, right, in partnership. And the first dance number I spoke about was the sale or disposition of a partner's interest, right? We call it the 3-step, or I did. And we talked about that generally you look at the overall gain, you pull out the 751 gain, and whatever remains is the 741 gain, right? And you guys, it's mechanical, all right? So go through the same processes that we did here, and that will bode well for your success on the exam. Tonight, we're looking at liquidating distributions, but before we do, we have to pause. And as we were getting towards the end of class, which is never a good time to talk about Code Section 751B, we spoke about Code Section 751B. Why is that never a great time to talk about 751B? It's a very complex code section. It's one of those code sections you have to be very careful about, because notwithstanding that many of you, myself included, will generally think of partnership distributions being tax-free, 751B says that if it's a disproportionate distribution, not proportionate, disproportionate. And if you look back at many of the problems that we looked at throughout this particular chapter, Chapter 10, the authors purposely said it was a proportionate distribution. That was to negate the application of Code Section 751B. The last part of this chapter deals with disproportionate distributions, where a particular partner gets too much or too little of ordinary income assets. And Congress back in 1954 was concerned that taxpayers using partnerships might game the system to try to get one partner, perhaps at a higher tax bracket, recognize the ordinary income, and another tax bracket, who, I'm not sure if I misspoke, the taxpayer at the higher bracket recognize the capital gains, the taxpayer at the lower bracket recognize the ordinary income. Again, why is the equivalent to Lucas v. Earl, income shifting, right? You remember good old apple in the tree, the fruit in the tree metaphor? Well, the fruit in the tree metaphor lives on. It lives on in the form of Code Section 751B. Don't worry, you got it. That's okay. So Congress, in the form of, in our textbook and in the code, directs your attention, and this is why you got to be careful, because if there is a disproportionate distribution, we have to go through yet another 3-step process, right? And this is what I spoke about towards the end of class. You have to compute what is the amount of the disproportionate distribution. To compute the amount of the disproportionate distribution, you have to have, so first is the computation. That's not even considered a step, but once you figure that out, step 1 is to make a phantom distribution. Step 2 is to have a constructive sale. And step 3 is to have a normal distribution. So you have a 3-step process whenever Code Section 751B applies. Again, let me repeat for your notes. First, you got to figure out the disproportionality numerically. What is the amount of disproportionate distribution? Second, you have to distribute out, and I said it before, I'll say it again for your notes. Distribute what the partner doesn't want. Distribute what the partner doesn't want. And then we will sell to that partner what the partner does want, and that partner wants to get rid of. Never wanted it in the first place. And then we will go through and do our normal distribution. So we will have this 3-step process. What's the objective here? Again, for your notes, just from when you look at this material, you have to understand why introduce such complexity. When you have an order, at least currently under Code Section 1, when the code tax rates for ordinary income is 39.6 and the highest capital gains rate is 20%, right, essentially 1/2, Okay? And if you have $1 million worth of income, by potentially gaming the system where someone's at a very low tax bracket, someone's at a high tax bracket, if you can manipulate it, on $1 million, there's $200,000 worth of tax savings. So it makes it attractive. As we will see, Code Section 751B is flawed. It does not work in many instances. And we'll see that there's a move, or has been a move in the past, to legislatively repeal it, but 751 has stood strong for over half a century. And at least unless I'm missing something in the new tax legislation, unless you guys tell me to the contrary, I've not seen anything that would suggest shedding Code Section 751B. So it's good news that you're here tonight. How's that? Any questions about 751B? Why do we do this? Because 751B really applies, we know 751 applies to ordinary income assets, right? That's what you pull out in a sale or exchange. 751B applies to substantially appreciated inventory. Okay? It's got to exceed, the fair market value has to exceed 120% of the basis of the asset. But, here's the but, is that when you look at inventory, it includes accounts receivable, and it also includes recapture income. So, let's face it, inventory in many of our clients' hands will not appreciate, right, greatly in value. It's kind of unusual, right, that inventory appreciates in the hands of the retailer. But when Congress broadened the definition to include, and for cash benefit taxpayers, think about it, to include accounts receivable, if they're accounts receivable, they have a zero basis, it can cause the inventory to look to be appreciated. All right, so the authors, what they do is they talk about the operation and why we have Code Section 751. Hopefully you guys read this, because the authors give a very nice description of how this works. And I have in the margins of my book, just on page 350, I have on the first paragraph, step 1, phantom distribution, okay? So page 350, the first paragraph deals with a phantom distribution. The next paragraph, I have step 2, deals with a phantom sale. So if you've gone through it, again, I think labels are important here. And step 3 is on page 351, and step 3 is distribution, just a normal distribution, so you have to know the material earlier in the chapter. It begins the constructive transactions described above are only part of the picture, and then goes on from there to talk about the distribution itself. Okay, so pages 350, page 351 describe in detail the 3 steps. On page 352, the authors at the bottom of the page talk about how to compute before and after. If you look at the A's comparative interest in Section 751 assets, you've got to look before and after. And then if you look right below that, there will be symmetry here. There will be symmetrical answers here. So that you should be able to check yourself to see if numerically you have the right answer. If the person's getting too much or too little, those numbers should always be the same. Busto?
How does a fraction change from a third to a fifth?
Because the person is not having a liquidating distribution, they're having a distribution where their percentage interest has declined. They used to be a 1/3 partner, now they're a 20% partner, 1/5. So that's what's going on there. All right? So the authors give us that again. The authors, I have to say, that's why this is the #1 partnership tax book used at graduate level. It's a very eloquent example, not hard to follow. If you guys have your espresso machine going, it would be helpful. You have policy consideration. I'll pause for 1 second. I didn't ask. I apologize. Any Thanksgiving stories? I did say in my other class that I did see, and I thought it was a fun movie, Baby Driver. Despite the name, if you haven't seen it, it's kind of an interesting tale. Any movies?
I saw the Bad Moms Christmas. Very hilarious. Very funny.
You thought it was good?
Yeah, I like it.
Rotten Tomatoes, I don't think got such good reviews.
Really? Did you like the first part?
I didn't see it.
Yeah, if people like the first part, they like it.
Okay. Anything else? Anyone see or do?
I went to medieval times.
Medieval Times. Okay, so you saw some jousting?
Yeah, we lost.
Your team lost.
Yeah, so it was upset. But it was nice.
Okay, that's a fun place. If you haven't been, Medieval Times, always fun.
I watched an older movie. It's 2 years old. The Hateful Eight.
The Hateful Eight?
Yes.
Was it good?
It was really good. Yeah,
All
I
right.
enjoyed it.
Hateful Eight. Anything else? Anyone else? No marriages, no engagements, nothing special over the holiday weekend? Okay. Michelle, you were going to say? I thought your hand was... Okay, so you guys are busy. Okay, Kelly.
I went to Iceland. And
Oh yeah, that's right. Did you see the Northern
I
Lights?
did not, because when we traveled around, and when we got to the north, there was a giant blizzard that covered the country.
Oh.
Which is not fun to drive in on mountain passes, by the way.
Yes, it was.
Oh, okay, Kelly, more importantly, did you make it to the Blue Lagoon?
No, but we did go to a few others. So we did.
Iceland is one of the places in the world, can I say this, Kelly, where when you turn on the hot water, you never put your hand under the water.
No.
Because it comes right from like volcanic, molten, whatever. I mean, Iceland is built on lava. And when they don't have to heat their water, they just stick a pipe under. And hot water comes out, and you can really scald your hands.
It's very hot. But the nice thing is that means all the bathroom floors are nice and heated.
Yes.
So when you come in from the cold, it's very nice. Yeah.
So then you warm up the houses, they get good.
Yeah, they get geothermal heat. Okay, so I don't think anyone can beat Kelly with an adventure over Thanksgiving. All right, back to 751B. All right, so the authors, beginning on page 353, talk about policy, okay? Why is there, why do we have this? And I told you, it all is derivative from Lucas v. Earl. Our chestnut case, Lucas v. Earl dealt with income, right? Assigning it to lower income tax brackets. 751B is all about character, right, guys? Okay? Different, but conceptually similar, okay? There are new proposed regulations. I will not hold you accountable for them. We will stick with the tried and true. On page 359, let's look at problem 1. These problems take a while to get through. For exam purposes, I would ask, here's my objective for this part of the chapter. That you guys can identify disproportionate distribution. So for exam purposes, if I had a quote-unquote simple 751B, would anyone get mad at me? All right, Lisa, admit it. You'll get mad at me.
I will.
All right, but I knew you were thinking that. But I would try to keep it real simple, okay? Because, again, a week, a month, a year from now, I'm not sure if you're going to remember all the detail. But if you remember enough to be scared, okay? I have done my job, you've done your job, because by being scared, you can stop yourself from getting sued by your client, okay? And that's always a good thing. So, I don't walk into any office, my office, and say, gee, this is easy any day I've ever been there. I am always scared, okay? So that's always, I don't know, you may say, can't you relax? You cannot relax. You can relax other places, but when you're practicing, guys, you will not want your doctor to say, hey, I'm just relaxing today while he or she is doing an operation. And the same philosophy extends to your tax practice, right? Your office is not the time to relax. It's time to get, hyped up. All right. So, just by way of review, we had the following balance sheet. Partnership distributes accounts receivable to A as in an operating distribution. After the distribution, and you'll appreciate this, Busto, It went from a 1/3, guess what, Busto, to a 1/5, right? You see that, right? We didn't take him out. He's still there. But because of the accounts receivable, his interest capital count went from 6,000 down to 3,000, right? So he has the 3,000 compared, and the total capital accounts are 15,000. Last I checked, 3 over 15 is what? 20%. Is that right? Yep. Okay. So the first question is, you got all the, I'll call it bad assets, right? And from B and C's perspective, that's a good thing, right? B and C are happy because what's left is the capital asset, right? So they would be benefactors here, and A would be bearing the burden, right? Everyone agree? So the first question before you start your 3-step dance, okay, is to put on the right pair of shoes. Okay, I know, bad metaphor. I know. All right. And the way to put on those pair of shoes, you got to figure out, right, Dill, what size you're wearing. The size is numerically, what's the disproportionate distribution, right? So I think I left off. I think I fed you that number to start the party right before we left 2 weeks ago. Everyone got the number down and how they got that number? Here it's pretty straightforward, right? You can eyeball this. Andrew, do you have that down in your notes?
Me?
Yeah.
I have a number down.
You know how we got it?
Yes.
What was the number you have down?
Spot. That's $2,000.
2,000? And Michelle, you know how we got it?
I guess I was thinking 1,000.
What? Andrew, you know how you got 2,000?
Yeah. I did the 15,000 times 1/3, 15,000 times 1/5, 5,000, 3,000, subtracted 2.
That's not going to get you there. That may be coincidence. You got to compare the 751 assets before and after, right? 751 assets before, he had how much interest in the 751 asset? $1,000 interest, right? 1/3, right, of 3,000. Everyone agree? And how much is he getting as a result when all the dust settles here, guys? 3,000. So he's getting 2,000 too much, right? Okay? And before, what was his interest in 741 assets? 5,000, right? The cash plus the capital asset equaled 15,000. He had a 1/3 interest, right? Everyone agree? 1/3 of 15 is 5. And now, he's got a 20% interest in 15, which is 3. So he's getting 2,000 too little, a 741. Everyone agree? Right, Andrew?
That's what I said.
I'm sorry. I didn't understand then. I didn't. I'll say, Andrew, my bad. You got number 2 has your name on it, so I can listen more carefully, okay? All right, so let's get through problem 1, and then Andrew will have the honors of problem 2.
Can you repeat the 741 again, please? Oh, we got it.
The 741 is before he had a 1/3 interest in cash plus capital asset, 1/3 of 15 is 5. After, he has a 20% interest in 15, which is 3.
We have it.
Is the plus minus always the same? Plus minus always the same?
Say again?
The plus minus will always equal. You said there's always
Yes, you're always going to get too much of something, too little of something else.
Okay, so if you only like what you did, just one side of it, then you already have a number, you don't have to do both sides.
You don't.
Yeah, yeah.
If you want to check yourself, though, you should.
Okay, got it.
Hey, man, you got that, right?
I got it, I just said.
I'll write the next one. Let's see. All right? Everyone's got this?
Isn't that 4,000?
What's that, Ashley?
He has a 20% interest now in 15,000 times.
there's two assets left, cash and capital asset.
Got it.
You got it?
Yeah.
All right, guys, let's go through this. Okay, so step one. We got to give our partner what he doesn't want, right? So step one is aggravating because this pen isn't right. But step one is what? Phantom distribution, right? That's step one. What do we have to give him? What does he want? Not want? He doesn't want 741 assets, right? We got to give him 741 assets, and the regulations say in the absence of an agreement, you got to give him a pro rata amount of the assets he doesn't want. So, what's my authority for that? Regulation 751-1G, example 4C. I'll repeat. 751-1G, example 4C. In other words, the partners can agree to give him a particular 741 asset, but in the absence of an agreement, he's got to get a pro rata share. And what's our 741 assets? Cash of 6,000, capital asset 6,000 of cash, right? And capital asset 9,000, right? Cash, capital asset, that's 15, right? 6 over 15 equals what percent? 40%. And 9 over 15 equals what? 60%, right? So we got to give him 40% cash, right? 40% of the cash is how much? 800, right? And we have to give him 60% of the capital account? 1,200, right? What's the adjusted basis of that? This is the fair market value. What's the ratio of the basis there, guys?
33%.
33%. Everyone see that? So what is it going to be? $400 adjusted basis, which is 33%. So we have to give a phantom distribution of cash of $800 and $1,200 of capital asset with a basis of $400. Okay? All right. Doris, what's the issue?
Yeah. Isn't 6,000 times 40% 2,000?
What?
1/3.
Then 1 divided by
1/3.
1/3 of 1,200 is $400. Okay? Now, we have to do a balance sheet because A is going to get those assets. We have cash, accounts receivable, capital asset, okay? Now remember, we're just giving A these two assets. So cash is going to go down by 800. Accounts receivable going to stay the same. The capital asset, right? We're going to give $1,200. And A is going to get a distribution. And his basis, right, goes down, right? And his capital, he's getting $2,000 worth of assets, right? With an adjusted basis of $1,200. All right, this is just a normal distribution. It's phantom, it's not really happening, where taxpayer A is getting $800 of cash, we're giving him $1,200 of a capital asset. What is that total? $2,000. Why are we giving him 2,000 as 741 assets? He doesn't want it, right? But we know he's going to get 2,000 too much as 751 assets. Everyone agree? So we're giving him what he doesn't want. All part of the grander scheme of things, right? Questions? If you don't get step 1, step 2 and 3 don't get any better.
Yes, I have a question. So capital assets is fair market value $9,000. 1/3 is $3,000.
Why are you using $139,000?
Oh no, $9,000 capital assets, $9,000
So
fair market value. 1/3 interest is $3,000 times 60% is $180.
No, but it's not 1/3 of that.
I know, it's right.
We're told to use a pro rata. We know 2,000 is the total, right?
Okay, now I understand.
And we know how that has to be comprised.
Okay, good.
Okay? Other questions? I don't know what you mean by that. This way?
Yeah, keep going. Thank you.
So the adjusted basis for the capital asset, basically you do the same, you would take 3,000 times 0.6.
No, and the ratio is, the basis to fair market value is 1/3 in that case. In other words, we know we have a capital asset worth 1,200. We know the basis has to be 400. That's consistent with the basis of that capital asset. All right.
So that adjusted basis, how much is
What?
adjusted basis for capital?
The adjusted basis is $400. I don't know what you're pointing to.
The third column.
That's the fair market value.
I think he means on the balance sheet.
Yes?
Yes.
What's your question? This is A's outside basis.
6,800.
Where do you see 6,800?
Okay.
That's a 1.
1,800.
Oh, okay.
It's a 1 comma.
Yeah, it's 1,800. Why is it not? It started off at 3,000. But under 732 and 733, he got distributed out these two assets. So his basis has to go down.
Sorry, I read it as 6,000.
Okay, I got it. Michelle, you got a question?
I just want to make sure, so whenever you apply this, the phantom distribution, it's always going to be these 751 assets. So whenever you see this,
Well, that's what it's all about.
well, I just want to make sure.
At 751, this is disproportionate. If it were proportionate, we wouldn't even have this conversation, right, guys? All right, step 2. Okay, step 1 is the phantom distribution. Step 2 is A does not want these two assets, right? A does not want these two assets. Agreed? So A is going to sell these two assets in return for what? Say it loudly.
It's
It's going to buy the accounts receivable, right? That's what A wants. We're going to give it to him now, right? So A is going to use these two assets to buy the accounts receivable. So step 2 is constructive sale. Okay? Now when A sells the capital asset, any gain or loss to A? $800 capital gain. Everyone agree? A's going to have an $800 capital gain. And what's going to happen when A sells his capital asset? He'll have an $800 capital gain, and the partnership is going to be selling $2,000 of the accounts receivable. Guess what? Is it going to have a gain or loss? Right, Karen? You're nodding, right? It's going to have a $2,000 gain. What's the character of the gain? Ordinary income. Who's going to be pegged with that? B and C.
What about A?
Not A.
He's still there.
It doesn't matter. That's not how 751 works. He's selling it to the partnership, and they're not considered. He's not going to pick up that gain. Okay? So the partnership has $2,000 of gain. On the K1, B and C would be eligible, would have that gain. And guess what? their outside basis is going to go up, right? Code section 705. So we're once again, the assets here, cash, accounts receivable, and capital account. Okay? And we have A, B, and C. And A, this is just a sale. So A is going to stay the same here. But B and C, their outside basis as a result of that $2,000 gain on the inventory is going to go up. And remember, cash, A is using $800 of cash to make that purchase of the accounts receivable. So cash is going to go up by $800 to $6,000. Now there's only $1,000 of accounts receivable, right? Because the partnership sold $2,000. And here the partnership bought $1,200 worth of capital assets, so its basis goes up from $2,600 to $3,800 because of the purchase. You guys see up there? Come on down. That's having problems. Come on down. All right?
Is the adjusted basis say 9,500? No, 9,800.
9,800. All right, Kelly?
Why for the accounts receivable is it still a 2,000, not 3,000?
Because now that's step 3. Listen, A only has $2,000 to sell of merchandise he doesn't want. You can't buy $3,000 of accounts receivable for $2,000 worth of merchandise. Okay? Step 3, we'll get rid of the accounts receivable. That's our third step. Okay, this is not a 2-step, right, Kelly? It's a 3-step dance. All right? Don't miss out on that third dance, third part of the step. Maria, you got this? All right, again, step 1, before we even get it, is figure out what is the disproportionate distribution. Once you figure it out, phantom distribution, give the person what he doesn't want. Step 2, the person sells what they don't want to get what they do want. And to use Kelly's example, they can't get all they want because they only have 2,000 of what they don't want. Step 3 is the normal distribution. And this time we won't give them the accounts receivable. This is just plain vanilla. Step 3 is just plain vanilla. Step 3 is just give them the final cachet of the receivables, right? We're going to give A $1,000 worth of receivables, right?
Yes.
And if we do, there's only going to be cash left and a capital asset, right? And the cash is going to stay the same. And the capital asset is going to stay the same this time. A, B, and C. What's going to happen to A's capital account? He's getting $1,000 worth of accounts receivable. It's going to go down. then at the end, what do you get to do? Raise your hand in victory. All right? So during the exam, if your hands go up, I was on a treadmill 2 days ago, and I think every fourth day you get to see, what is it? Picture, not, what is it with the dancing and they made it part 2? Picture perfect, not picture perfect. What is it? No. What's this dancing where they get up, they have to perform the women versus the men? There's a movie. Pitch Perfect.
Pitch Perfect singing.
Yeah, the singing.
Yeah, Pitch Perfect.
Pitch Perfect, right? And Pitch Perfect at the end when they're doing their dance number, and they do what was the movie they had to? And she replicates the song at the very end, and he raises his arm like this. All right. What's that?
Right?
So again, Dawn?
From Breakfast Club.
Yeah, from Breakfast Club. Anyway, so at the end, Dawn, you can give the cheer up, right? Pitch Perfect. That's right. Pitch Perfect. Okay. You guys ready?
When you
I don't see
say,
the fist. I just see a hand.
yes.
Come on, guys. When you raise your hand, keep it in a fist here. Yeah, still.
When you say pro rata distribution, or not a pro rata distribution in this case, if A had only gotten $1,000 the AR in the initial distribution,
That's a disproportionate distribution.
that's just
Absolutely.
even though that's a share of it.
Doesn't matter.
So you still have to go through this
Yep.
stuff.
Yep.
Does anything happen? Because
Yeah, you'd have to then go through because his percentage interest goes down.
okay,
It's a nightmare.
all right.
Okay? I didn't see a fist. Yes.
Can you just clarify why he wants accounts receivable and he doesn't want cash in the capital asset?
Oh, he may want it, but that's not what happened. We know he's going to get $3,000 of accounts receivable. That was the deal.
So why are we doing the cash and capital assets first and then?
Because we got to give him what he doesn't want. That's how 751B works. Abandon distribution of what you don't want.
Okay. And how do we know that he doesn't want it? That's
Because
not
we
the-
know at the very beginning of the problem, he disdains them. Because he's only getting the receivables, right? We're told that. Read
okay.
between the lines, Annetta. He does not want them.
Okay.
All right? Use your imagination. All right?
That's right.
I think I'm just getting this muddy with other concepts now, but this is specific for distribution. So if you have a special allocation.
There's no special allocation.
That
None.
doesn't really.
No relevance here.
Okay.
Gabe, you getting this?
Elaborate.
All right.
Brainstorm.
But again, guys, 3-step process. Give them what they don't want. Okay? Have them sell what they don't want back for what they do want. And step 3 is just the normal distribution. All right? Ready to do problem 2? Because I know Andrew's chomping at the bit. But
Step 2, when you sell the accounts receivable,
be careful about the pronoun you. Who's selling?
when
No.
it's a
The partnership is selling the accounts
partnership
receivable.
sells what they don't want, but they're not actually selling, it's just theoretical.
When you say theoretical, they're going to pick up $2,000 a gain.
So why does cash only go up by $800?
Because when you say that he's using $800 and $1,200 of capital assets to purchase the AAR. That's why cash is going up by $800. That's what A has now after the phantom distribution. Ashley, I'm sure you'll get this. All right, ready for problem 2? All right. Good position for the board. Everyone can see it? All right. Question 2. ABC has the following balance sheet, which is the same as the second hypothetical discussed in the text. Okay, before, hold on 1 second. Let me just make sure I covered. We did reconstruct the balance sheet, and the increase in the inside basis is allocable to B and C. Okay, They're the benefactors of any increase in the inside basis. Great. Question 2. Okay, question 2 says, initially each partner has a 1/3 interest in the partnership. Capital's profits and losses. The partnership distributes cash at $27,000 a day. Okay, last I checked, that looks a little disproportionate on its face. Don't say it yet, Andrew. I know you're at the edge of your seat. Everyone come up with what numerically you think, because if you don't get this right, guys, you've blown it. And that's not good. Like, you're going to take 15 minutes during an exam to figure it out. And from step 1, you're wrong. That's not good. So we're going to go from a 1/3 to a 1/9. Figure out what the disproportionate amount is.
Excuse me, quick question before we get to that. What about the B portion of question 1?
Because the inside basis of the capital account went up by $800. That benefit of the added $800, that benefit should inure to B and C. They should get the benefit of that extra $800 worth of tax basis.
For B and C.
Yep. Okay, try to figure out numerically what the disproportionate distribution amount is. Everybody have a number. Andrew, what's the disproportionate amount?
16,000.
Okay. I'll call it Eman. You have a number?
15.
How much?
15.
You have one? Andre? Aaron?
12 on one side and then 8 on the other, so that's 15.
So what do you say the disproportionate amount is?
I came up with 2 different numbers, so I knew it wasn't right. So,
Oh, so you're checking yourself.
yeah.
Checking that list twice, making sure it's right. Okay, little Santa Claus there. Okay. Eric, you had the number. Hey, guys, you should be able to eyeball at least one of these numbers, right? I mean, look at inventory, little inventory, right? What was it before? What was his interest in this evil 751 asset? 12,000, right? 1/3. Now, afterwards, what's his interest? 4,000. Damn it, he's getting 8,000 too little. Everyone agree? He's not. Look, before he had an interest in 751 assets of 12,000. Afterwards, he's only going to have an interest of 4,000, right? That means he's getting 8,000 too little, right? Wasn't he entitled? Wouldn't he have been saddled with 12,000 of ordinary income? Everyone agree? And if he gets all this cash, right, he's only going to have to recognize ultimately 4,000 of ordinary income? Yes or no? If you don't see that, that's bad. That's not good.
Where did you get the 4,000 again?
That's 1/9 of 36,000 of inventory. His interest drops from, you see that? He will have a 1/9 interest in the inventory. Okay? So he's getting 8,000 too little inventory. Karen is getting stuck and saying, well, I see that. I think, Karen, you saw that, right?
Yeah, that one I had.
Okay. And you might say, what was his interest in 741 assets before? 24. Everyone agree? 72,000 times 1/3 is 24. Everyone agree? And now, how much cash is there after the deal settles?
27.
No.
Nine.
But after is 9, right? There'll be 9,000 cash, and land will be 36, right? Which equals 45, right? Times 1/9 equals how much? Equals 5, right? Plus 27 equals how much? 32, right? In other words, and how much, before he had an interest of, we said, of 24, there's the difference of 8. Let me go slowly here, okay? Is everyone agree beforehand he was going to get $24,000 to 741 assets, right? Everyone agree? He had a right to $24,000. Where did I get $24,000? That is cash of 36 and land of 36, right? Times 1/3 equals 24. Everyone agree? 24. Agreed? Okay. After, when this deal settles, when he gets his cash, he's still going to be entitled to 1/9 of 45,000. Agreed? Where's 45,000? That's cash of 9,000 is going to be left, and the land is going to have a value of 36. Right? Total's 45 times 1/9 equals 5, right? And he already has 27,000 in cash, right? Because that's what's being distributed to him. So after, he'll have 32, and that means as a result of this distribution, it's disproportionate as to 8. But we knew that, right, Karen? Because he wasn't getting any of the inventory before and after. He was getting too little inventory to the tune of 8,000. Right, Andrew? I mean, just do the arithmetic. Before, with inventory, before equals 12, after equals 4, the difference is 8. Everyone agree? Usually one of the numbers you can eyeball quickly, the other one takes a little bit more, right, Karen? But you should be able to do it. Anyone have a problem doing this? Everyone ready to move on? Because I want to erase this because I want to get the 3 parts here.
I'm not following the 4,000 after for the inventory.
Okay? Look at the inventory. It's going to total still 36,000, right? What's his interest in it? 1/9. What's 1/9? You got that? You good?
What were the 741 before and after?
741 before was 24. That's easy, right?
Yeah.
The after is, after the deal, there's cash at 9, land at 36, that totals 45. His interest is 1/9 in that, or 5, plus he already has 27,000 in his bank account. So after, he's going to end up with 32,000. All right? So what's our first job here, guys?
Phantom distribution.
Phantom distribution. And what are we going to give this sucker? We're going to give him what he doesn't want, right? He definitely doesn't want the inventory. We're definitely going to give him the inventory. Everyone agree? Yep. Everyone know it. We're going to give it to the man. Okay. So we're going to have this phantom distribution of $8,000 of inventory.
And that's because he didn't get any 751 assets.
Right, he didn't get any he got too much 741 assets. Lucky him, but he ain't so lucky under 751B. So we have assets, cash, inventory, and land. That's the basis, fair market value. So what do you think is going to happen when we give him a phantom distribution of $8,000 worth of inventory, guys?
Inventory is going to go down.
The inventory is going to go down by how much?
By 8.
By $8,000. Right? The numbers here are not hard. And you have to apply your normal distribution rules. He's going to take a zero basis in that. Step 2.
I can't see. Or just read the numbers.
I mean, what? Ashley, it's not going to help. If you got to come out now. If you can't see, there's several seats up here. All right? All right. Constructive sale, right? What are we going to sell here?
Cash.
Okay, he's going to use the partnership's going to use cash, and he's going to get rid of the inventory, right? He's going to sell it. Come on, Amore's got a seat right next to her. All right, right in the front there, Ashley. All right, all right.
Oh my God. Wow.
See, there's a whole new world down here. All right, so we're going to sell. And there are seats up here. If you guys are, Evelina, if you're having problems seeing, come on down. Okay? Anyone too? Okay? We're going to use the inventory. He's going to use the inventory, sell it back for cash, right? Okay? So, what's going to happen here? Cash is going to go down, right? By how much? $8,000. You guys are on it. Is A going to have a gain as a result? He's going to have 8,000. What kind of income? Ordinary income. That was the whole purpose behind this. He was going to get too much 741. We're not going to let him. Or Congress isn't going to let him. So he's got to recognize 8,000 of ordinary income. And the partnership's buying back inventory, right? So the basis will go up by 8,000, right?
Okay, so how did he recognize it?
Yeah,
Where's the $8,000?
It's just like a normal sale. He's selling. It's like under 707. He's like a third party selling inventory.
On a scheduled day on 1040, it doesn't show up.
It's not going to show up on the partnership. It's like he's a third party selling inventory to the partnership.
Why didn't B&C's
No?
If the partnership had no cash, would you then go for the land, or how would
When you say that, we know he's going to end up with cash, so I can't speculate if it had no cash, it would be an entirely different problem. Okay? Eric, I'm not sure what your question is.
Why didn't B&C go up to 22,000?
Why? I mean, they're using the partnership's using cash.
That's right.
So are we saying it's like considered an unrelated party?
It's like an unrelated party, just selling inventory. Right? And the land is going to stay the same. All right, so this is the thrust of this disproportionate distribution. And now we have to do the third step, which is just our normal distribution rules that we covered last week, right? And what are we going to distribute to our taxpayer? Cash. Of how much?
19.
19. Don't say 27. You already got the 8, right? All right? Good mistake to make tonight, not next week. Okay? How much cash are we going to distribute today? 19. Okay? What happens to A's basis? Drop it to 0. Anything else happen today? Right. He has income of 1, right? Under 731, he has cash distribution in excess of basis, right? Everyone agree? cash distribution in excess of basis, he will have a $1,000 recognition event. Okay? That's code section 731A1. Okay, you got that? So A has a $1,000 recognition event. And I'm just pointing out that inside and outside basis will not match here with that recognition event. And that is true in 85% of the cases, unless there's what in place, guys? Say it loudly.
754 election.
Unless there's a 754 election in place. All right, so let's summarize. First, we computed, right, what the amount of the disproportionate distribution. And you can look at it from either angle. Is he getting too much of one thing or too little of the other? Whatever the case may be, look at it whichever way you want. Then numerically, it should be the same. In this case, we computed $8,000. He's getting too much of $741. So we had to give him what he didn't want, which was the $751 asset in this case. And we did. Gave him $8,000 of the inventory, right? He didn't want it. He sold it back to the partnership. Partnership wanted it or took it back and used cash to buy it. And then we just had our normal distribution on the difference between the two.
So they don't have to give him piece of land instead. If cash is good, yes.
Well, the only thing here, he wanted cash. So I don't know. That's akin to Kelly's issue. I think you can't mix it up here. His destiny is to get the cash, guys, not the land. That was not his destiny.
I don't think you're going to ask us for the exam because you don't want to complicate our lives.
I don't want to at least they're really mad at me.
If partnership's a jerk and gives A the $27,000 cash and gives B, say, all the inventory or whatever, or a disproportionate share of inventory, how do you order these two? Because I imagine you have to do this process for both A and B's distribution.
Right. Dill is asking what happens if two different partners, one gets one and one gets the other, and they're disproportionate as to each other. I've never had that come up. I've had it where they're trying to get rid of someone, usually in a liquidating distribution, and I have to be the bearer of bad news. I don't know. I have to think about that, Dill. But I will not, on the exam, ask that question. How's that?
So
all right?
Step 2, you're theoretically saying that you're selling the inventory.
Well, just be careful of your pronouns.
The partnership is selling the inventory, but then buying it back for cash.
I don't want to say selling the inventory. It is selling the inventory for cash and not buying it back for cash. It's
why does the cash?
Hold on. We distribute the inventory, right? $8,000 of inventory out. It is buying the inventory using its cash. Period. Let me say it that way, Ashley. It is buying the inventory using cash.
What have been over this information here? $35 and $36?
Where are you looking? That's because A had to recognize $1,000, right? And there's no 754 election. That's why the inside and outside basis doesn't match. We'll talk about that in a moment. This is correct, the numerically correct answer. I just want to call that to your attention, even though you don't have symmetry on the inside and outside basis. Okay?
So I have one more question. If in our case, he would be getting land instead of cash. In our
I can't go. I don't want to do that because Kelly knows he's getting cash.
No. But it would be land instead of cash. In exchange, it would be inventory exchange for land.
Okay.
Okay.
If that ultimately his destiny was to get the land, yes, we would be doing this with the land. Okay, and that might, because it's appreciated land, might trigger a gain at the partnership level.
doesn't want? Is it because you wouldn't want ordinary income?
Well, in this particular, I don't, each partner is going to have his own tax circumstances, and some might be in a low tax bracket, some might be in a high tax bracket, so there's no universal.
He doesn't want what the problem solves, he doesn't get. Think of it that way.
Right. Doesn't want what he doesn't get. Think about it. There's more of these, so don't worry if you don't see them immediately. We're going to do more. Okay, so question A, guys, this is the outcome right here. You're looking at it, okay? Question B. What difference in result would it have made if there was a 754 election and 754 triggers the application, if you recall, of a 734B adjustment, 734B1 adjustment, 734B1 capital letter A adjustment to be specific. And here, not surprisingly, in this case, because taxpayer A had a $1,000 capital gain, and we can't allocate that to cash, right? The basis here, if there was a 754 election, the upward adjustment would be $1,000 to the land, and there, Louise, you would get the symmetry I know you crave. Okay? So that's under Code Section 754 election, triggering the application of the 734B adjustment of $1,000. And question C.
And that's, I'm sorry, that 754 basis gets allocated to B and C because they're the, so if the partnership were to sell the land tomorrow,
right,
that additional basis
would be allocable to them. It's like you reverse the 704C principle.
Okay, so it goes to the other partners.
Right, B and C would be the benefactor of that.
Okay.
And we'll not get that complicated for the exam, but just calling to your attention the implications of the 754 elections.
How do you know to select the land? Like, why couldn't you adjust the inventory?
Because it's the same character of whatever A recognized here. I'm sorry, in the distribution, he recognized under 741 a capital gain, so you have to allocate it to the capital asset, not the ordinary income asset. Question C. Assume the inventory on the balance sheet at a basis of 24 instead of 0. Could the partners have avoided the application of 751B by using cash to purchase $36,000 worth of additional inventory? And what the authors are suggesting here, very quickly, is that if that were true, what is the fair market value of the inventory if they had bought another, I think they said 36,000 of inventory, right? The fair market value of the inventory would be 72,000, right? 36 plus 36 is 72. Everyone agree? So the fair market value of the inventory would be 72. And they said assume a $24,000 basis. And what's 24 plus 36? Is 60, right? And what the author's point is, remember, Code Section 751B only applies if the inventory is substantially appreciated, right? Everyone agree? It only applies if it exceeds the fair market value exceeds the adjusted basis exceeds, not equals or exceeds by 120%. Everyone agree? What's 120% of 60, guys? 72, right? So you might say, hey, if you want to avoid 751, purchase inventory, right? Because that's a way perhaps to make the inventory not substantially appreciated, right? But there's a code section that specifically says if you do purchase inventory to avoid 751B, this doesn't work. Code section 751B3, capital letter B. Let me repeat. Code section 751B3, capital letter B says, hey, if you go out there and just acquire inventory to try to negate the application of 751, that's ineffectual. That does not work. Question 3. The 734B adjustment is inapplicable. You know what? I'm not going to worry about question 3 for our purposes. You're not going to see that in the exam. So let's move on to question 4. A, B, and C are equal partners in ABC partnership, which has the following balance sheet. The partnership distributes $9,000 worth of accounts receivable to A and $18,000 worth of inventory to B and C. Okay? Everyone see that? Take a pause, take a deep breath. Everyone see what's being done here? 8,000 receivables to A, 18,000. Everyone's getting $9,000 worth of goodies. Agreed? Everyone's on my page, right? Does that feel proportionate or disproportionate, guys?
It feels proportionate.
It feels proportionate. Everyone agree? Yeah. Everyone's getting a little taint here, right? Because they're all getting 751 assets. Agreed? Yes. Having said that, does 751, does it apply here? That's a yes or no, not a probably. Doesn't count here, Alicia. Does it apply or not?
I would take 18 times 120. And
it doesn't apply.
Yes. The unrealized AR.
Yes, it applies because if you take 18 times 1.2, it's.
You just told me you're committing an oxymoron. You just said it was proportionate. 751, if you notice the prefix, it says disproportionate. D-I-S, right? Does 751 apply? Hell no, right? Can't apply here. It's all proportionate. Then the authors rhetorically say, this is a pretty stupid statute because when you think about it, look what the games you could play, right? Because look at A. A's getting $18,000 worth of inventory, excuse me. A's getting the accounts receivable, right? With an embedded $9,000 of ordinary income, right? B and C are getting left off the hook, right? Yeah, but the point is, they're able to manipulate the system where maybe in this case they can all game the system because A may be in a lower tax bracket than B and C. And this is exactly the policy objective that 751 was designed to curtail, but it doesn't work here. Like you can manipulate it as long as you're proportionate with respect to your asset distributions. So the authors here, are just illustrating it in problem 4. As long as you're proportionate, 751 doesn't really do its job. All right, that's what the point is here. Everyone see that? 751 does not apply here. Period.
Professor, if B and C got a capital asset, that would be a different story, right? Because it wouldn't be proportionate, or would it?
Right, it would not be proportionate. Okay, A and B are individuals. The partnership has the following balance sheet. Partnership distributes all the cash to A, who thereafter owns a 1/4 interest in the partnership. A is at the 15% tax bracket, and B is in a much higher marginal tax bracket. How would you structure the transaction? And everyone see if A gets all the cash, his interest is going to go down, right? Busto, this gets back to, it's going to go from a 50-50 partner down to a 1/4, right? His capital account will be $2,000 out of a total of $8,000. Everyone agree? So, Andrew, you're once again called to task. Everyone figure out, take a minute. Let's see if you get the first part right. What is the amount of the disproportionate distribution here? Okay? So, numerically, guys, what's the amount of the disproportionate distribution here? Together? 2,000? Mark, do you agree, disagree? 1,000. I have 1,000, 2,000. Anyone? Benny, you have a number?
I would say 2,000 too.
2,000. Benny, how'd you get that?
Okay, I took, now before the distribution, we had 6,000 of all the assets, right? Half and half.
Yeah, you had 50-50 of each asset.
Okay, and after the distribution, it has just 1/4 of what is left, I guess,
Yes.
which is 1/4 of 8,000.
Okay, but isn't it easy, if you don't mind me saying, at least one part is always easy. Before the transaction, how much of the 741 assets was he entitled to? 2,000 in cash, agreed?
Yep.
How much cash is he getting?
4,000.
Seems to me he's getting 2,000 too much of the 741, right? Everyone agree? Omar, did I see it any other way? And before he was entitled to $4,000, right, of the receivables, and after he's dropping to, right, a 1/4, or
I thought he was entitled to 1,000 before.
what was that, Amber?
Isn't he a 25% interest?
After he has a 25% interest, not before. Is it 50-50 interest before? Right, Amber?
So you want us to do the assets individually?
No, before I had.
Yes.
Amber, you got it, Amber? All right, but you don't want to do that next week.
I thought it was 25% going in and then.
No, but be careful, okay? Don't be your own worst enemy, okay?
You have to look at all the 751 assets.
All right? Again,
So if you take the ER, so before he was entitled for 2,000, right, half of 4,000. And then after that, it was 1/4 of 4,000.
but hold on, I think are you looking at, why are you just looking at the AR? Group the 751 assets versus the 741 assets. All right? Because otherwise, you're going to shoot yourself in the face.
So when you look at the cash, before he was entitled to 2,000, but he gets 4,000 of it.
Right.
So you don't do a 1/4.
Right.
I mean, and then you can look at the other assets and just cross-check yourself. Right, Ashley? Right?
Yeah.
Okay.
I just got confused because I was looking at doing a 1/4 interest of cash.
You do. It's 1/4 of 0 is 0. Plus you got the 4,000. So you combine both numbers. It's 0 plus 4,000. Which is 4,000.
All right. The author's only point here, and I don't want to go through the entire problem here. I think problem 1 and 2 illustrate, the three-step process. But the author's point here, as I called your attention before, that the regulation 751-1G, example 3C, I'll repeat, 751-1G, example 3C, allows the partners to come to an agreement, which, remember, what assets are we going to give taxpayer A here? What he doesn't want. Everyone agree? And normally, if there's no agreement, what will we give him?
Pro rata.
Pro rata, right? Which would be 1,000 of receivables, 1,000 of inventory, right? Everyone agree? Because that's what we did before, if you recall, with the 2,000, cash of 800, 1,200 of the capital asset, we did it pro rata. But the partners can agree and manipulate the system, okay? So in the absence of an agreement, it has to be pro rata. But if we were strategic about this and taxpayer A were truly in a lower tax bracket, A and B might conspire and say, you know what? We'll give taxpayer A which of these two assets? The AR, right? Because he's in a lower tax bracket. So we could conspire, distribute in a phantom distribution the $2,000 worth of AR and let him recognize that his lower tax bracket, the income, the ordinary income. But we won't go through the entire problem because time is not our friend tonight.
Isn't it all ordinary income though? It's inventory?
When you say that, It is, but down the road they can manipulate the system and will protect B for a later date. Okay? Hold that thought. I mean, all the author's point in having this problem here is just to illustrate that regulation gives flexibility to partners to decide which assets to be used for phantom distribution. Anytime you give partners flexibility, there's going to be an issue. For exam purposes, I probably would just have it's going to be pro rata, okay? Akin to what you already saw on the first problem, okay? Not to complicate your lives. I'm just illustrating for your purposes, life is not always as simple as portrayed.
For this one, I think I don't get it. It seems like it's all ordinary cash, non-distributable inventory.
Yeah, but if you go through the numbers, and we're not going to go through them, you could manipulate the system where ultimately C could be protected. So as just the notion here is flexibility. Okay. And the last question, you know, the authors are asking rhetorically, and at some point, 751B is one of those code sections, again, it's one of those landmines that are in tax. What do I mean by landmines? Where, you know, there's a provision in the code, we're all hardwired to say distributions don't give rise to taxable income generally, but there's a lot of times, guys, whether in a non-liquidating context, and guess what, in a liquidating context, what do a lot of partners who you want to say goodbye to, what do they want, and what do you end up giving them? Cash, right? They say, I want out of here, and we say, okay, we'll give you 100,000 or 200,000 cash.
Go away.
Go away. We don't want you. And life seems good. We're going to get rid of that person. But then we didn't realize, damn it, there's a disproportionate distribution because we have embedded in the partnership agreement substantially appreciated inventory, and all of a sudden we got to go through this three-step process. All right? So I'm just warning you that on the face it seems innocuous to us, and oh, the tax consequences, oh, that's just going to be to the selling partner. And they may not be, because as you bore witness to, taxpayer B and C all of a sudden are in the mix, and they didn't anticipate being there. And it's okay if they are in the mix, but you've got to give them the warning, because it's when taxpayers get blindsided. And when I've seen this happen, and you might say, hey, what's the chances of us being audited? Okay? I've heard that a lot. Okay? But what ends up happening at some point is a year later, I'm just going to make this up, that I've seen this happen. Use one of the big four firms comes along, KPMG, I'll use them, and say, they come along and they say, oh, you want to buy this partnership, but we looked at the Form 1065, and when they did this deal last year, they screwed up. They got to file amended returns, and there's back taxes and penalties owed. You can't close on this deal until they clean it up. And all of a sudden, people discover God and say, oh, this is your fault. You never told us. So it's not the IRS that's going to pick this up, but there's going to be some transaction a year or two later that some big accounting firm is going to pretend they're heroes, like, oh, look at what we picked up. Your other small accountant screwed up, but now it can be cleaned up, and meanwhile, it's coming at your expense, all right? So that's when I've seen very unhappy campers, all right? So that's why, don't just say, well, just slip right under the radar screen. It may not, all right? Good news for your team is that when we talk about liquidating distributions, we get an, how do we say, an affirmation of what you just picked up. Because guess what? Liquidating distributions have many of the same elements that we're looking at here, including our three-step dance, okay? So, chapter 11, let's talk about liquidating distributions because I owe it to you, all right? And now, keep in mind, liquidating distributions are going to be somewhat similar to sales, okay? Liquidating distributions are somewhat similar to sales, and we know when there's a sale, right? When there's a sale of a partnership interest, 741 comes into play. We got to figure out overall gain or loss, pull out the 751 ordinary component, and whatever remains is our 741 capital gain or loss, as the case may be, right? But this time, instead of a third party buying it, it's a redemption, right, of sorts, where the partnership is buying the interest, okay? The partnership is buying the interest. And I have to tell you, this seems on its face like it could be confusing. And let me, over the years I've had of experience, let me see if I can impart what I picked up, and let's see if it works for you guys. Open up to code section 736. Let me make an observation that the did I say vast majority of time, when it comes to liquidating distributions, the majority of cases will apply 736B, not 736A, okay? 736B is your pivotal code section. And when a partner's interest is being liquidated under 736B, which I just told you, is going to be the mainstay here. Essentially, as you might anticipate, and do a little role play here, if you're being liquidated out of a partnership, what do you want? What's your objective as a partner, guys? You want to maximize your financial wealth. Everyone agree? Yep. And what you primarily do, if you're a partner, you scratch your chin a little bit and you say, gee, here's what my capital account says, and maybe or maybe not, it's been adjusted to reflect fair market value of what's on the balance sheet. But you want whatever your economic stake is in the assets of the partnership. Agreed? So that's where the focus of your attention is. Agreed? Everyone agree that that's going to be the thrust, and that's what you want to extract from that partnership. And that essentially constitutes your 736B payments, right? They are, 736B reflects those things on the partnership's balance sheet, okay? There's nothing mystical about this, and that's why this is the bulk of most liquidation payments or 736B payments, because if you're scratching your chin, you're thinking about what's in that partnership and you want fair dollars, right, for what's on that side of the balance sheet. Agreed? And someone may be willing to pay you a premium of sorts to get rid of you, but that's not often the case. Again, the majority of times it's going to be 736B payments. And what the authors do is say, this is what we learned in last chapter, right? This is very similar to just a regular distribution. So it talks on page 364 that you have to reduce the person's outside basis by whatever cash is received. And then, not surprisingly, on page 365, we go through our normal distribution rule. You know, what is the basis of the property that is going to be distributed to us? Okay? Been there, done that. The only thing different is that when it comes to a liquidation, Congress permits losses to be recognized for a liquidating distribution. And why does it permit losses to be recognized? Because it will amount to what are capital losses, not ordinary losses, capital losses. All right? So capital losses will result as a result of a partnership liquidation. If the partnership didn't allow the loss now, what would end up happening, and we'll go through some examples, it would result in potentially ordinary losses. So the code is geared to permitting losses, but Congress wasn't born yesterday. The nature of the losses allowed will be capital in nature. Generally, what are the tax consequences to the partnership as a result of a liquidation? A big goose egg. Not much. Okay, if a partner, one of your fellow partners is being liquidated, not much will happen with one or two caveats. One caveat will be if there's a disproportionate distribution, heads up, all of a sudden alarm bells go off. And two, if the partner has a gain or loss, if the person who's being liquidated has a gain or loss, if there's a 754 election, there must be an inside tax basis adjustment. So I repeat that generally when there's a liquidation of a partner's interest, there is no effect on a partnership with these two caveats. But they're real caveats, and one must be careful.
You said that 754 bit again?
That if there is a 754 election and the partner whose interest is being liquidated has a gain or loss,
okay,
it's likely to lead to a tax basis adjustment.
Okay.
Okay? All right. So we are talking about a liquidating distribution. And again, good news, this should affirm some of the things you picked up in prior chapters. Again, one other thing is going through here, I now have my list of about 8 people who are going to take the exam at 6 o'clock, everyone else at 5 o'clock. Jen? Jen, what's your question? Oh, okay. If you have a problem, let me know. But aside from that, if you don't tell me in advance, you must come at 5, okay? The default rule is not 6. The default rule is 5 o'clock, okay? Okay, so bear that in mind. I'm only going to have a certain number of exams with the proctor who's going to be there at 6. And I need you to know, again, my expectation is you're going to be here at 5 o'clock unless you tell me in advance. All right, let's keep going here, guys. So we have the ABC partnership on page 369. It's not made a 754 election. It has the following balance sheet. Okay? In liquidation of his interest. Now, Fusto, you'll appreciate this. We're not going from 1/3 down to 20%. We're going to whatever percent down to 0, right? That's the big difference here. Everyone agree? In a liquidation of his interest, A receives 1/3 inventory and parcel number 1. Everyone get the visual, okay? What are the tax consequences of this distribution? Okay? Take a look. Is this a disproportionate distribution? Isn't that fundamental to ask that question first and foremost, right? Is it disproportionate? Brianna, what do you say? Yes or no?
Yes.
Yes, what?
It is disproportionate.
Why? But this is not. He's getting his fair share. He's getting his 1/3 of 751 assets, getting his 1/3 share of 741 assets. Everyone see that? There's $180,000 of 741 assets. He's getting 1/3 of it, and he's getting 1/3 of the inventory. Granted, there's no disproportionality here. Okay? 736A does not apply here. Okay? Because He's just getting his fair share of what's on the other side of the balance sheet. Agreed? So 736A, which we'll talk about shortly, does not apply. Right, Lisa? 736B does, but there is no disproportionate distribution here.
What problem are you looking at?
I'm sorry?
What problem is it?
This is on page 369. Problem 1.
Oh.
Okay. What are the tax consequences? This is just going to be a normal distribution, right? Does taxpayer A have any gain?
No.
No. What are we going to do first? What are we going to consider the distribution?
First inventory.
He's going to have a basis of what in the inventory? 5,000. Everyone agree under 732, you get a basis equal to the partnership's basis first in the inventory, right? You take over, I see Benny, your head's going north and south. Do you agree, right? All right, so he takes a $5,000 basis in the inventory, just what we saw last week. What basis will he have in the land?
You got parcel 1, so 100.
Say again, Dill?
You got the whole parcel, right?
He got the whole spaghetti.
Hang on, he's only got...
But he only has an $80,000 basis left.
Right.
We can't give him more than what he has, right? So his basis would be what here, guys? 80,000, right? And you should know this from last week, right? His basis here would be $80,000.
And we do nothing with the leftover, yes?
You do nothing with what?
With the 20,000 leftover.
I don't know what you mean, do nothing with the...
Because land has 100.
Yeah, but that's okay. You can't take more of a basis than he has. So his basis here will be $80,000. Okay? The holding period in the land will be tacked. What's my authority? Code section 735B. And the inventory comes out with a new holding period, and it's got a 5-year taint under code section 735. So for your notes, the effects here, partnership has no gain or loss, but the partner takes out inventory with basis of 5, right? Fair market value of 10, and gets land with a fair market value of 60 and an adjusted basis of 80. Tax holding period in the land, new holding period in the inventory, but the inventory has a 5-year taint. Any gain or loss to the partnership? No. 731B. No effect to the partnership.
Hang on, I have a W question. Why do we do the inventory first?
Because 732 says first allocate basis in the inventory. Okay? Not me. That's what the statute says. 734B. 732B. 732B says that.
Oh, that was from before. Right.
And so there is no effect to the partnership or its inside basis. Okay, there's no effect. Had there been a 754 election, right? Were there a 754 election, remember the basis in the land went from 100 down to 80. Everyone recall that?
60.
No, it went down to 80. Guys, went down to 80. The basis went from 100 to 80. So there was a $20,000 of basis that disappeared. Everyone agree? Had there been a 754 election, there would be a $20,000 basis adjustment allocable to parcel number 2. Okay? I'm just calling that to your attention. That had there been a 754 election, there would have been, under 755, there would have been a $20,000 adjustment to land number 2. that's the answer to problem A. Very similar to what we looked at last week, where the distributions generally have no immediate tax consequences to the partner or the partnership, but you have to know the rules under 732 relating to what is the basis the partner will have in the distributed assets. That makes for good multiple choice questions. You know, what is the partner's basis, right, in the asset distributed? So you should know that. 80,000 in this case, and in the inventory 5,000.
To the partner.
I'm sorry?
To the partner, right?
I'm sorry?
80,000 to the partner.
The partner, but I don't want to, it's in the land. Right? He doesn't have a personal basis. It's 80,000 in land number 1. Go on.
And then they're just distributing those assets to the partner holds them, and then when he sells, or if he sells these items, that's when he would recognize any gain or loss.
Absolutely, John. It's a preservation. The code section preserves the gain or loss. Question B. In liquidation of his interest, A again receives 1/3 of the inventory and also receives 60,000, this time of cash, guys. Okay, everyone ready? We're not getting land this time, we're getting cash. What are the tax consequences? And you know, Brianna, I'm going to ask you if there's a disproportionate distribution here. And this time you're not going to assume anything, you're going to answer what you think based on logic.
Yeah, I'm going to say there is a disproportionate.
And if you say so, you better tell me where you see the disproportionality. Ashley, are you agreeing? Helping your neighbor?
I think so. My thought process is that he's only getting 75 and his basis is 14.
Where do you see he's only getting 75? I don't know what you mean by that.
1/3 interest in inventory is 5,000 and the cash.
Hold on,
Sorry,
hold on.
65. He's only getting 65,000.
Where do you see that?
1/3 interest in inventory is 5,000.
Why do you say that? 1/3 is 30,000. Last I checked is 10,000.
Does the inventory change?
I don't know what you're talking about. The fair market value is 30.
Oh, now we look at the fair market value. Oh, never mind. This is not disproportionate.
Okay, but you don't get a second chance on the exam. Okay? This is not fairly disproportionate. He's getting his 1/3 interest again in the 751 assets. He's getting his 1/3 interest in the 741 assets. No disproportionality. Everyone see that, right?
And that's absolutely enough if we take just the hot asset and calculate it with 0.
He's getting his 1/3 of the hot assets, right? He's also getting 1/3 of the 741 assets. He's made whole financially. These are 736B payments. He's getting his fair share. It's on the other side. Now, what does the cash distribution do to his outside basis, guys? Reduces it to what?
25.
Reduces it to 25, right? Everyone agree? The cash distribution reduces the outside basis from 85 down to what? Well, first we're going to take the cash and reduce his outside basis from 85 down to 25. Everyone agree? No. Stop there. Everyone agree? Cash distribution is going to reduce his outside basis dollar for dollar. Agree?
Yes, sir.
And guys, when we do this, make sure you're looking at basis versus fair market value, right, Ashley? Don't mix and match. You got to know which is which. So his outside basis is going to be reduced. Okay. Now, so his outside basis is 25, and he's going to get inventory worth what? With a basis of what? Worth what? He's going to get a basis worth 5, right? Worth 10, right? Everyone agree? Right? Everyone agree? What the heck are we going to do with that $20,000 that's unaccounted for? Do we want to give it? Do we want to give it in the inventory? Because if we gave it in the inventory, he's going to sell it. Dawn, to your point, he's going to sell the inventory and recognize ordinary loss. Congress is not happy. Congress does not permit him to assign that basis to the inventory, right? So what happens? He gets a capital loss. This is one of the few times in this circumstance where you get cash and hot assets, you will recognize the capital loss was my authority, Code Section 731A2. I'll repeat, 731A2. Benny.
Where did you get the 20,000 difference?
I'm sorry.
The 20,000 difference?
Well, because his basis went from 85 down to 25, right? Because 85 minus 60, the cash, so it's 25. Now he's getting a distribution of inventory with a basis of 5, with a fair market value of 10. And there's 732, his basis in the inventory becomes 5, so it absorbs 5 of the 25, that leaves 20 unaccounted for. Hence the loss. Okay, Kelly?
Recognizing the loss in the year of the liquidation? Or
Is it the year of what, Kelly?
of the liquidation?
Absolutely, the year of liquidation. Okay?
What kind of loss is that?
Long-term capital loss. Long-term capital loss. Subject to the limitations under Code Section 1211.
Is the $5,000 that reduces 25? Does that have to do with?
That's just the normal rules under 732 and 733.
Does that have to do with the basis or the fact that it's worth 10,000?
It has to do with the basis. Look at the rules under 732 and 733. All right? So your answer, guys, again, in problem A, taxpayer is going to get this inventory with a basis of 5, fair market value of 10. Going to have a 20,000 long-term capital loss. Generally, the partnership has no gain or loss under 731B, right? But if there were a 754 election, there would be a $20,000 downward adjustment of basis, and because this is a capital loss, it would be allocable to the land 1 and land 2 in proportion to their fair market values. So that $20,000 downward adjustment would be allocable. 2/3 would be of 20,000 to land 1. 1/3 of that 20,000 to parcel number 2. In other words, again, generally, if there's no 754 election, there's no adjustment to the tax basis here to those assets. But in the case of a 754 election, there's a downward adjustment of 20,000, but it's allocable between the two capital assets here in proportion to their fair market value. That's my authority, Code Section 755. Kelly.
And if there were 754 elections, would A still recognize the long-term capital loss?
Absolutely. So, I mean, one has nothing to do with the other. A will have that capital loss come hell or high water. 754 only has an implication to the remaining partnership. Okay? Okay, question C. Why is the recognized loss under, again, question C is just an F. Why is the recognized loss under 732A2 limited to liquidating distributions and further restricted with regard to the nature of the distribution? The authors are just emphasizing that we want to force a capital loss, or not we, Congress wants to force a capital loss here because, to Dawn's point, if we allocate that remaining basis to the ordinary income asset, we're going to enable the taxpayers to secure an ordinary loss where otherwise they would be saddled with a capital loss. what result in A above, 2A above, and if the inventory were worth 120 rather than 30, A's interest obviously was to go up to 100,000, and A received cash of 60 and 1/3 of the inventory. So I have in my margins that if you look here and you increase the inventory's fair market value to 120, right? And A's interest was worth 100. Overall, A has a gain, right? Because if you look, A's capital count shows fair market value of 100, adjusted basis of 85. Everyone agree? So he has a potential gain of 15. Everyone agree? Yep. Right? Just write the little numbers there. I have in my margins, I wrote here, inventory in blue, I wrote 120, and next to A's capital count, I wrote 100. Okay? So everyone see that A has a potential gain, looks like 15,000, right? Difference between 100 and 85. Agree? Now, you might say, what happens in this circumstance? In other words, as a result of getting the cash distribution, what will happen to A's outside basis, guys? It'll go down, right? Benny, right? It'll go down from 85 down to 25, right? And then, right, Amber, the inventory is going to pick up 5 of that remaining 25, right? And notwithstanding that he has an overall gain, right, he's still going to be forced to have a 20,000 long-term capital loss, right? Everyone agree? He's going to force. You might say, there's an injustice here. There's an injustice. But, Dawn, can you connect the dots and tell me why there's no injustice here?
Because when he sells the inventory, then he'll have the I don't know.
Yes, you do. How much gain will he have on the sale of the inventory?
Oh, because now we're 120.
And he's getting 1/3. What's 1/3 of 120?
40, and then.
And his basis in it is what?
5, so then we'll have 35.
And what loss did he have?
30.
He had 20. He has a gain of 35. What's the difference between the two?
15.
One hand, one place. Okay? All right. Everyone agree? Everyone see? You see how the logic comes out? This is not, just throwing out numbers, right, Dawn? This taxpayer has $15,000 gain here as a result of his investment in this partnership. But the way we're going to walk down this road together, he's going to recognize 20,000 capital loss, coupled with a 35,000 of ordinary income. The numbers all make sense. The author's point here is, notwithstanding the gain, when you only distribute out cash in 751 assets, you may have to be saddled with a capital loss. That's the author's point here.
Can you go over where the 35 ordinary gain comes from?
The inventory that's being distributed is 1/3, right, of 100. The inventory is now worth 120, right? What's 1/3 of 120? 40, right? What's the basis? 5. The gain is 35, right?
Oh, so it's ordinary upon the sale of the inventory.
Yeah.
Okay.
And we had a $20,000 loss showing your notes.
Yeah.
And you amalgamate that, 15,000.
Why 20 is
Because that's his remaining basis that's unaccounted for. That's his interest, not his basis. His basis is remaining the same. Benny would tell you, his basis goes from 85 down to 25 down to 20. You got it? Okay? Look, hopefully everyone's having fun. This is what it's all about. Okay? You ready? Okay. Question 2. Partnership. Now this is a fun one. Another, look at this. You guys should handle this. It's very similar to what we did last week. Ready, Javier? Of course. All right. Partnership distributes capital asset 1 inside basis with an embedded gain. Right? Everyone see that? Right? Sal, you see 35,000 embedded gain. Right? Capital asset 2 inside basis. No appreciation. Partner A in liquidation of A's interest in the partnership. Prior to the distribution, A had a $55,000 outside basis. Determine partners A's basis in the 2 assets. Take 1 minute. It's exam time. I ask the question, what is the basis? Come up with numbers for these 2 assets, guys. Yeah, and the exam would say, what's the basis in asset 1? What's the basis in asset 2? These are 2 distributed assets. Andrew, you got the numbers?
I got numbers.
Want to share them?
In asset 1, I got 37. Asset 2, I got 18.
37, and what's the other one?
18.
Anthony, you agree? Anthony, you have numbers? Anyone else have different numbers? Feeling comfortable about? Heidi, you got some?
383.
You know what it has to add up to?
55.
Sorry?
44 and 11.
44 and 11. Alicia? 44 and 11. I think we'll go with that. Step 1. What does Code Section 731C1B say? You assign each asset whatever the basis it has in the partnership, right? Everyone agree? So with respect to asset 1 and asset 2, we're going to assign it a basis of 5 and 10, right? Everyone agree? And we've used up $15, 15,000, whatever number you want. Okay, everyone agree? Starting point is to assign whatever basis the partnership had in the asset. Agreed? And the second step is to assign 732C2A. I'll repeat. Code Section 732C2A says allocate basis with respect to unrealized appreciation in proportion to such appreciation. Here, only the first asset has appreciated, right? How much has it appreciated by? We said it before? 35. So we've used up 35 of the basis, and that means we have 5,000 more to allocate, right? Because we know the allocation has to equal 55. Everyone agree? And the third step, this is under 732C2B. I'll repeat. 732C2B says you allocate it in proportion to fair market value. Okay? What is the fair market value of each asset here? Okay? 40 and 10, right, is the fair market value of each. So what proportion is this? This is 80%. This is 20%. Everyone agree? How much is it left here to allocate? 5. Right? So 80% of 5 is 4. 20% of 5 is 1. So this is just illustrating the application of Code Section 732, where it's a 3-step process. First, you allocate whatever the basis the partnership had in the assets, then in proportion to the appreciation. then in proportion to the fair market value, whatever remains. The 4 is 80% of whatever, in this case, the remaining 5,000. That was what was left to allocate. That was left so far unallocated. Right, Louise? We already did. We already did 50 of the 55. He had an outside basis of 55, right? Step 1 and step 2 took care of 50 of the 55. So we had 5 more left that we had to allocate. Right? All right? We're good? Question 3. ABC partnership has the following balance sheet. A receives land 1 as a distribution and liquidation of his interest in the partnership. Both parcels of land are capital assets to the partnership. Brianna. Disproportionate or not? And Ashley, see if you agree.
We're on 3.
We're on 3.
Yeah, I'm going to say it's not. Yeah.
What are you going to say?
We didn't get to really read it yet, but we're going to guess.
All right, go. Don't guess. Take a look. Everyone take a look. See if this is disproportionate or not. Kira, you too. I'll ask you if it's disproportionate or not as well.
We're going to say no.
You're going to say no what?
It is not disproportional.
Hold on, let me just ask Kira, do you agree or disagree? Kira, I think you're whispering.
I think I disagree.
The word I think, you either disagree or you don't. And Chad, you can chime in too. Mary, you're going to say? Is it disproportionate or not? Kira, yes or no?
Yes.
Disproportionate. Chad, agree or disagree?
Agree.
And if so, Chad, by how much? Kira? Javier? Jen? Numbers? Disproportionality?
I would say 4,000.
Kira? Guys, what was he entitled to before? Eyeball. He was a 1/3 partner. How much is evil assets, hot assets?
2,000.
Inventory. He was going to get $2,000 of inventory. Agreed?
Yep.
What's he going to get after he's liquidated? 0. He's getting shortchanged of $2,000 of inventory, guys.
So long. This looks exactly like the other problems.
I don't know what the problem is, Ashley. Guys, Chad, you see that? Yeah, Ashley, you got to come down. You're missing the board.
I know, I was learning so much now.
All right. Yeah, I think those heights are going to your head there. All right?
A didn't get any inventory, and that in and of itself should be a signifier, right?
Yeah, the fact that A didn't get any of the bad assets, guys, should be loud and clear. Alarm bells going off.
Are there going to be questions around 12.5 assets, like the recapture?
Don't worry about that. I'm not going into the minutia. I mean, you can see, so people are struggling with the simple questions. But guys, you got, again, I'm being realistic with myself and with you. I'm not sure how much you're going to remember about the 3-step process, past Christmas break. But if you identify that there's a problem where if someone says to you, hey, we want to get rid of this idiot A, and we're going to just distribute land and call it a day, that may not be the end of the story here. And like I said, the problem may not be the IRS auditing you. It may be another accounting firm who comes up and decides, hey, your mess has to be cleaned up. All right? And that's where I see the issue.
Is it because it's a capital asset?
When you say that, yes. He's receiving a capital asset, and there's 751 assets that he's not getting. Hence, actually disproportionate.
Got it.
You say it now. Let's see if you say it later. All right. Let's do our magic. Everyone ready to dance? Do the 3-step here. All right, guys, let's do the 3-step process here. So, PD, phantom distribution.
That's 2,000 inventory.
So, what are we going to give our taxpayer A?
2,000.
Yeah, we're going to give him what he doesn't want. Everyone agree? Let's stick it to him.
What a jerk.
What a jerk. We don't want him anymore. Out of the club. Everyone agree? We're going to give him a phantom distribution of inventory. Agreed? Because he doesn't want it. But step 2, he's going to sell it back to us, right? And he's selling us what? He's selling us $2,000 of inventory, right? And what's he buying with his inventory? Land worth how much? $2,000. He can't buy more. He may want to, but he's only going to be able to buy $2,000 worth of land. He's going to have $2,000 of ordinary income, and B and C are going to sell land with a $2,000 fair market value. And what basis in the land?
Hang on, slow down. What was your question again?
The partnership is going to sell land 1 to A, worth $2,000 with a basis of $1,000, right?
Got it. Yep.
Okay, everyone agree? Right thing? So, B and C will each pick up $500 a gain, capital gain, and A is going to pick up $2,000 of ordinary income. Okay? So, cash, inventory.
And your question was, what was the basis of the inventory that the partnership buys back, right?
The basis of the inventory
that was the
is
question.
going to climb up. Yep, right. It's going to go up to 2, right? Because we're buying it back. And land 1 is going to decline in value because he's just bought $2,000. And B's outside basis is going to climb because the partnership had to recognize a gain on the sale of the land. Step 3 is our normal distribution. And what are we going to distribute out?
The rest of the land.
The rest of the land, right?
Right.
Just a normal distribution. So land 1 is going to disappear from our balance sheet. A, by the way, is going to be terminated, right? So A no longer exists here, right?
That's a little morbid.
A little bit morbid, but true. Now, what basis does A take in land 1, guys? What basis?
And the basis of 3, and on the basis of 2.
What basis will A take over in land 1? What basis will he take over in this portion of the land? His outside basis, remember, is 3.
And the land is a capital asset.
And the land is a capital asset.
So you allocate the rest of his basis.
You allocate the rest of the basis to land 1. So his basis in this part of land, remember, he bought using inventory. He already has land with a $2,000 basis. Everyone agree? Land 1 with a $2,000 basis. And now this portion of land 1, he's going to take over with a $3,000 basis. What's my authority? Code section 732. So his total basis in land 1 will be $5,000 for your notes. $5,000 will be his total basis in land 1. Needless to say, it says, what if there was a 754 election? What would it be? Well, there's only, remember, we added an extra $1,000, right, to land 1's basis because, and what essentially 754 says is that if that's the case, we have to subtract that extra 1,000 here. The basis here would go down to 2, and then we would have our symmetry under code section 754. Okay? What's my authority for that? That $1,000 downward adjustment is under 734 B2B. I'll repeat. Code section 734 B2B would require a $1,000 downward adjustment.
And if that was a depreciable asset, you would just reduce the depreciation expense year after year? So if it wasn't land,
yeah, it was just
it would offset the actual the regular price
going forward. Yes. All right. Look, the point of these first series of problems under 736B is that a liquidating distribution shares virtually the same attributes of operating distributions that you saw in the last chapter, okay? So for your notes, this is largely reflective of what we did last class, okay, at the beginning of last class. Let's talk about 736A payments. We're going to skip question 4 for our purposes. It's not something that we need for my purposes. 736A, okay, payments are rare, okay? 736 payments are rare. And they really come up, if you look at 736B2, 736B2 says 736B does not include payments in exchange of an interest shall not include unrealized receivables of the partnership or goodwill, except to the extent it's stated. If it's stated goodwill, if it actually says it's goodwill, then it belongs as a 736B payment. Let me repeat that, because let me make sure everyone hears me at 8:30 on a Wednesday night. If the goodwill is stated in the agreement that it's a payment is being made for goodwill, it's stated that there is a payment being made for goodwill, that is a 736B. It's a real asset on the balance sheet, right? Everyone hear me? Remember how we said if you're a partner being liquidated, you want what's on the balance sheet? Well, if it's on the balance sheet, it's a 736B payment. If it's not on the balance sheet, it's a 736A payment. So B2, 736B2 says unrealized receivables and unstated goodwill are 736A payments if it's for a general partner in a service partnership. I'll repeat. It can be 736A payments apply generally with respect to general partners of a service partnership for unrealized receivables and unstated goodwill. And essentially what they are, these 736A payments, they're really, in most instances, a guaranteed payment. They're saying to the person, gee, you did a good job here, or whatever the case may be, and you deserve, beyond whatever's on the balance sheet, something more, okay? And that's going to be deductible to the partnership and includable as ordinary income to the partner. So generally, from the partnership's perspective, there is a very much of a conflict here. The partnership wants 736A payments. Why? You heard me. Deductible. The partner does not, because it's ordinary income to the partner. So there's a real tension here. 736A, bad for the partner being liquidated, good for the partnership. Everyone have that? And this is not, well, sometimes it could go the other way around. This is a universal. Everyone, for your notes, just try to remember this. 736A, bad for the partner, good for the partnership. Does it come up a lot? Only in the context of service partnerships, generally. Now, and I'm just going to call this to your attention because we're going to see a problem where this comes up, but people miss this. It doesn't apply to all the goodwill. If you look on page 372, page 372, if you look under payments for goodwill, it's actually more limited than you think. If you look at the second sentence, in the second paragraph under payments for goodwill, it says, but section 736A assumes jurisdiction over such payments. They are made to a retiring general partner in a service partnership to the extent the payments exceed partner's inside basis, if any, in the goodwill. So 736A only applies to the portion of the goodwill that exceeds the adjusted basis. So if there's value beyond the adjusted basis, that's the 736A payment. The adjusted basis itself is a 736B payment. Now I know you're like, what is he talking about? I get it, I get it. Hear me, just make a note in your notes that circle that and circle the reference to footnote 54. That's the site. You'll see this, and we're going to go through a problem where I will highlight this. Okay? So I just want to call that to your attention, and when you go through or we go through the problem, I'll call attention to this. Okay? There's a reference here to premium payments. Okay? This does not come up too much. If you look. This is one of the only times we just said that 736A payment, very narrow, only applies to a service partnership. Not going to come up too much. Not too many general partnerships out there. Okay. However, if you look at the second, or I should say the third line on page 373, it says any payments in excess of the amount of that amount in the form of cash or other property that are governed by 736A, regardless of the legal form, general or limited of the partnership, I'm going to fill in the blank, is this 736A payment. And what I'm saying here is that if you are a partner in a partnership and you're being liquidated and someone's paying you some sort of premium beyond what's on the balance sheet, that can be a 736A payment. Okay, I'll repeat. Someone's paying you something more. That's kind of surprising, right? They're paying you more than what you deserve, right? That's a premium payment. Well, what the code has essentially said, that's a 736A payment, that's a guaranteed payment. They're essentially paying you for something, some service or something else you did. That should be ordinary income to you, deductible by the partnership. Okay? And we'll see how this comes up in a few minutes. Okay? They talk about the tax stakes in here, and it's just what I told you. The tax stakes are generally where partners do not like 736A payments, partnerships do. And there's cases on page 375 where in Smith v. Commissioner, just a case that illustrates the 736A payment, okay? 736A payment is a case of first impression. It's the IRS wins. It's going to be ordinary income to this taxpayer. You guys can read the case. It's not a very hard case to read. Taxpayer argues that he should have capital gains, and the IRS says, no, this is a 736A payment, ordinary income, and the facts prove correct. It is a 736A payment. Commissioner v. Jackson, again, very easy case to read. And what this case illustrates is that even at the last minute, the partners made an amendment to the partnership agreement. They wanted to change the outcome. And the question is, if you make a last minute adjustment that changes the outcome, is the IRS and is the court bound to respect that? In this case, said yes. In other words, if you can get all the partners to agree, it can be the moment before the person is liquidated. If they all agree to a certain treatment, that's the nature of 736A versus 736B. The Congress said the partners had liberty to manipulate the outcome. Okay? So in this case, an amendment was done last minute. The tax court originally said that shouldn't be respected. The taxpayers were manipulating the outcome. The appeals court said, hey, that's perfectly permissible, and allows that outcome. Do not, for exam purposes, we will not worry about the timing. There's on page 383, there's a discussion about how to time the receipt of 736A versus 736B payments. I will not ask. I hope Lisa, you're not disappointed. I will not ask a single question about that, okay? All right. So let us look on page 385, problem 1. I want everyone to make sure you get a taste of what this is all about. So problem 1 talks about someone having a 1/3 interest in ABC partnership for several years. It is one in which capital is a material producing factor. A has an outside basis of $12,000. Has not made a 754 election. What are the tax consequences to A in the partnership, B and C, if A receives a $20,000 cash payment for his interest? The agreement makes no provision as to goodwill. Okay? So take a quick look. Try to absorb that. So since this is not a service partnership, the accounts receivable and goodwill are 736B, okay? This is not a service partnership. Only 736A payment here. Notice, A's capital count is 18,000. Everyone agree? He's being paid 20. Anyone take an aroma? Deep breath. $2,000 premium. Everyone agree? That's a 736A payment. Agreed? And that's going to be treated as a guaranteed payment. Right? He's getting $2,000 no matter what. And that $2,000 is going to be deductible to the partnership and to B and C. And that's going to reduce their outside basis, right? Because under 705. Now, let's pause for 1 second. A is receiving $20,000 cash. Is this a disproportionate distribution? Is this a disproportionate distribution, guys? By this stage of the night, everyone should get this.
We got no AR.
Excuse me?
A got no AR.
A got no AR. What would he have been entitled to before? 1/3 of, which is how much? 9?
3,000.
3,000. How much is he getting now? 0. Okay. Now, he would have gotten 3. The disproportionate part is after the deal, he's getting 0, so he's getting shortchanged by how much? 3,000. So there should be a phantom distribution, right? Of 3,000, and we should go through our 3-step process. Everyone agree? Right? We're not going to do it because we don't have the time. But I want to help you identify what is the 736A payment. And what we've done, Dawn, right, to identify the $2,000 premium here. It's the 736A payment. And to identify this disproportionate distribution. Okay? Question, Kelly?
Would the premium affect that 3-step process?
No, it's off the table. Okay?
So hang on. So obviously A's outside basis goes to 0 because they're out of the partnership. Get the 20K cash. Recognizes you said $2,000 of ordinary income from the guaranteed payment. Right?
Yeah, I'm sorry.
That was the end of the results to A. That's it.
Yeah, I'm not going to go into any more depth. I would just say this. A is getting, what do we say, $20,000 in cash. The first $2,000 is off the table. Let me leave it at that for your notes, okay? Let's go to question B, okay? What result in A above if substantially all the income consists of fees for personal services, okay? So pause for a moment. How does that change the possible outcome? Don't say it out loud, think for a moment. What's 736A? What's 736B? Okay, does anyone have a dollar amount they want to say is 736A and 736B?
A's still receiving all cash, right?
A's receiving cash. Now, it's a service partnership. Well, we know in 736B2, it's a service partnership. That takes the accounts receivable and goodwill, if it's unstated, and in the agreement it's unstated. It says no provision is made as to goodwill, right? So that takes it out of being a 736B payment, right? If you look at 736B2, it says 736B does not include, and it lists the receivables and goodwill for a service partnership, right? Everyone agree? So, for your notes and edification,
What exactly is your provision for goodwill? What does that mean? Before you said that the goodwill's on the balance sheet, and that looks like it's on the balance sheet, so now I'm confused as hell.
Yeah, but they're not, when they make the payment, they don't specify any payment is being made for goodwill.
Okay.
Okay?
Got it.
There's nothing in the agreement saying we're buying goodwill.
Okay.
Okay? All right. So the 736 assets that remain, okay? Cash remains a 736B asset. Everyone agree? Mm-hmm. And his interest in there is $8,000, right? Let's just go through what are the 736B payments, assets. Cash of $8,000. The capital asset, right? He had a 1/3 interest of $15,000, so it's 5. So it's 8 plus 5 plus, and this is what I was alluding to before. What's the basis in the goodwill? the basis in the goodwill remains a 736B asset. The basis of 3,000. What's 1/3 of that? Is 1/3 of 3,000 is 1,000. So for your notes, the 736B payments equal 14,000. Again, what's my authority for that? 1/3 of the cash, 1/3 of the capital assets, and 1/3 of the adjusted basis in the goodwill. My authority is that footnote I directed to you before. The remaining 6,000 is 736A payments. Okay, what is that attributable to? 1/3 of the accounts receivable. What's 1/3 of 9,000 is 3,000. 1/3 of the appreciated goodwill, right? The goodwill appreciated from 3,000 to 6,000, plus a $2,000 premium. So, in this case, for your notes, 736B payments equal 14,000. 736A payments equal 6,000. That $6,000 is deductible. It's treated as a guaranteed payment, right? Treated as a guaranteed payment. It's going to be ordinary income to A and deductible by the partnership. And in this case, for your notes again, the partnership will have a deduction, like I said, of 6,000. That deduction will inure to B and C. 751B is not applicable here. I know, Brianna, you were curious about that. Why is 751B not applicable? Because there's no disproportionate distribution, because the accounts receivable, right, are off the table. They're treated as a 736A payment, right? There is no hot assets here.
Where did you get the goodwill amount? The
goodwill amount, remember, the adjusted basis is a 736B payment. Only the appreciated portion is considered a 736A. Right? And that's the footnote I directed you to before, Michelle.
Could you just go over the 6, so 736A, and what is that made of?
Yeah.
The 6,000 of 736A is comprised of 3 components. Okay? The $3,000 of accounts receivable. You got that? $3,000 of accounts receivable. $5,000 of excuse me.
No, so much.
3,000 of accounts receivable. I'm looking at this. 3,000 accounts receivable. 1,000 of the goodwill, right? That's the appreciated portion, Andrew. Okay. 1/3 of 3,000 plus the $2,000 premium, right? Which is always a 736A payment. Okay? So for your notes, again, 14,000, 736B, 6,000, 736A. There is no disproportionate distribution because there is no considered 751 assets here. Okay? Now, Dale.
If there was a provision of goodwill, how would that change?
We'll get to that.
Okay.
All right? All right. Now, in question F, it says, what if, in question F, it says, what if a provision provides for goodwill? How would that change?
He doesn't care about timing.
We're skipping all the timing questions. What would happen? Give me a breakdown. What's the 736A and what is the 736B with respect to that? Well, what that would do, if there's stated goodwill, that becomes part of the 736B, right? Everyone agree? In the agreement, if it provides for payment of goodwill, so the 736A would go down by 1,000, 736B would go up by 1,000, because now goodwill is no longer considered the appreciated portion is no longer considered 736A payment is now considered a 736B payment. So Andrew, you have that?
It goes up by 1,000?
1,000. Remember, for the prior problem, only 3,000, only the appreciated portion was considered 736A.
Right.
Now it's all. Okay?
Alright, so it's just the full, got it.
Okay. Now, just to see if you got this, let's just go quickly at problem 2, just to identify what it is. It has the following balance sheet. Discuss results A, B, and C. If A receives $10,000 of cash, $5,000 in receivables, $5,000 in inventory. So he's essentially getting 1/3 of all the assets, right? Everyone agree? He's getting 1/3 of everything, right? Does 736A apply here? And the answer is no. If you receive everything pro rata, there is no 736A component, right? Because you're just getting what's on the balance sheet. And Brianna, you'll be glad to know 751B doesn't apply because it's a proportionate distribution. What happens instead if he received $24,000 in cash and capital is material producing? What is 736A and what is 736B?
The only 736A would be the premium payment.
Okay, right. The only thing that would be, and how much is the 736A? How much? $4,000, right? A would be receiving a $4,000 premium, so it would be a $4,736A payment. The balance would be 736B. Is this disproportionate? Michelle, what's the problem? We're on problem 2 on page 385.
Are you still on 2A?
We're on problem 2A. Well, now we're in problem 2B. We said in problem 2A,
Which I got that.
okay, it's just proportionate, and now we're in problem 2B. In problem 2B, we said there's a $4,000 736A, right, premium payment. And we said, is it disproportionate? Because the other $20,000 is going to be paid. Does it look disproportionate, guys? What do you think? Yes, it's disproportionate, right? Everyone agree?
So
how much is it disproportionate? Guys, isn't the accounts receivable and inventory you should have gotten how much before? No, was 30. Should have gotten, yeah, 1/3 of 30 or 10. How much is he getting now? 0. Disproportionate of how much? 10. And we're going to assume a pro rata distribution. So we get on the phantom distribution, 1/2 of the accounts receivable, 1/2 of the inventory, right? Right, Alicia? All right, so for your notes, guys, for problem 2B, the answer is 4,736A payment, 20,736B, and there's a $10,000 disproportionate distribution under 751B. Amen. What's the issue?
Can you repeat again? 20,000? What?
736B payment. Okay? Now, just to, again, just sensitizing you, because we don't have to go through the entire thing. I'm just trying to, in problem 3, the partnership distributes all the inventory to A, right, in liquidation of his interest. Does that seem to be problematic? Is that it?
You get any 741 assets.
In this problem, I'm sorry, go ahead, Bill.
I just said he didn't get any 741 assets.
He would not get any 741 assets. It could be a disproportionate distribution, okay? Here's what I want you to, a few things I want you to take away, okay? With respect to liquidating distribution, let me just also call one other thing that can come up in practice a lot. Look at code section for a moment. 708. Okay. 708 B1A. Code section 708 B1A. And B1B, code section 708 B1B. Just want to point out that if there is a sale or exchange of partnership interests, and if you notice there, where more than 50%, there's a sale or exchange of 50% or more, not more than 50%, 50% or more, a partnership terminates, okay? Just wanted to be aware that if there's a sale or exchange of 50% or more, the partnership terminates. And as such, if the partnership terminates, okay, you have to get a new EIN for the partnership, okay? And it's a new 1065. Just be forewarned that sometimes these liquidations, when I say liquidation of a particular partner, and the sale of a partnership interest can result in a termination of a partnership. All right? I just want to call that to your attention. Now, in terms of just closing out the material for the exam in Chapter 11, a few odds and ends. Keep in mind that the vast majority, let me just summarize, 736B is the big ticket item here, okay, guys? Is that 736B is very similar to what we looked at in last chapter. In other words, the 736B functions in large part how we saw things function before. And you got to be aware of Code Section 732 and apply it and figure out what is going to be the basis of the distributed assets. 736A does come up, but it comes up infrequently. It can come up with respect to premiums. It can come up with respect to service partnerships. If it does come up with respect to service partnerships, it comes up with service partnerships with respect to AR and goodwill, which is in excess of adjusted basis. I repeat, Michelle, because this was the issue you raised before. Comes up with respect to accounts receivable, and not all goodwill, Kelly, only the appreciated portion, okay? It's going to be a 736A payment. So just make sure you can identify it. Let me also say, for the next week or so, because our exam is next week, if you need to take, I'm assuming the vast majority of you can make it at 5 o'clock. But there's a few of you who are planning to take the exam at 6 o'clock. Don't worry, I got you covered. I will be around this week, so if you get stuck or confused, I'm sure no one's going to get confused. But if you do, I am here to help, so just shoot me an email. I will carry the book wherever I go the next week. All right? So good luck studying. It's been a lot of fun this semester. See if you guys can close it out for next week, okay? I'll see you next week.